Hello people, this is a tutorial for a Streamlit app that I made for pair trading analysis. Now, in short, in pair trading analysis, we try to find two assets that are co-integrated and so their prices tend to stay together. Upon divergence, the undervalued asset is bought long, the overvalued is sold short, and when the prices revert back to their historical equilibrium, the trade is closed and we realize our profit. Now, the good thing with this strategy is that it's market neutral. That means that it doesn't depend on if the market goes up or down. It only depends on the relationship of our pair. So, in this app, you basically uh, type in the desired ticker symbol that you want to compare which assets you think have some connection to to perform a pair trading strategy and the selected date period. And you also have a training data size ratio, which will be the percentage of data that you want to use for training robust maximum likelihood estimator. The reason why we use a robust one is because financial data have outliers and are heavy-tailed. So 25% here would be around 2 years worth of data. So we're just going to use the default values for now. We're going to get our data. And here it will plot uh, all the things that we need to see and take into consideration. So first things first, we have the head of our data frame. We can see that the dates correspond. We can see our log price comparison. We have a configuration test. We have our training parameters. We have our gamma estimation. Gamma is basically beta in linear regression, and mu is alpha. We have our spreads for its model that we use. So basically, how we trade is we use the spread to trade, and we also use Bollinger Bands, and we have the standard deviation of the spread. And basically with that, with one standard deviation, now it's our entry signal, and we exit when the z-score is 0. So when it reverts to equilibrium, basically. Now the good thing is that we can change the parameters here at the side and see how it will affect our profit. This would be best with a validation dataset, but we don't have that now in this program. Let's check for 30 days, and let's change the significance level to 1%. So we see that our linear regression with a lookback period of 30 days performs much better than 60 days. We see that our spread is still stationary, which means it's mean reverting even for 1%. Now, what else can we do? We can change the alpha parameter, which is used to tune the Kalman filter. Now, with a higher alpha, we have faster responses to changes. With a lower one, we have a smoother estimate. And with higher values, sometimes it will adapt to noise, which we don't want. And sometimes with very low values, it might not adapt to values that are important. So let's see with 3 what will happen. Now, Kalman momentum basically, instead of having only mu and gamma, it takes into account the rate of change of gamma. So therefore, momentum. And we see how the models perform with our process noise being 0.003. Yeah, it's not good. So the 6 was better. So you can play around. You don't need to, but do need to refresh the page if you want to change the assets, the training size, or the, the period, the start date and end date. So let us refresh and let's see one more asset. Let's use Ethereum and Ethereum Classic, and let us change the end date to 2014 of December, and the training data size to 40%, 41, let's say. So here our program states that the first available date is from 2017. You see that the dates correspond. We see that the series is not cointegrated, but our hits, our spread is stationary. And we can see that our Kalma momentum has a quite big profit from 2021 to 2025, 330% profit. Market neutral strategy. Now, this could just be luck. This could be a false positive. That's why we use a portfolio of pairs. If someone told you at the casino that you have 51% edge over the casino, you would not play all your money into one game. You would split it into much smaller bets, much smaller bets, and play in a lot of different tables to reduce your variance and get an edge on the market. So the same you have to do with pair trading. You need to have multiple pairs, a portfolio of pairs. Now, this is the tutorial. I didn't really do a deep dive in what pair trading is and why I used the models that I used and how they work and how they are coded. If you would like to see that, I would leave me a comment and I'll make another video on the subject. But for now, you can play around with this model and have fun. So, yeah, thank you for watching.